What's up traders? In this video, I'm going to break down ICT's charter price action model 2. I will show you exactly how to trade it as a short-term weekly model. Also, this is not a theory, this is a step-by-step trading blueprint from preparation to execution to trade management. Exactly how ICT intended it. If you have been confused about weekly bias, Tuesday manipulation, or where entries actually come from, this video will bring clarity to you. Let's start with what is ICT's CPM Model 2. This is a short-term trading model that focuses on weekly range expansion. The goal of this model is to identify the weekly directional bias, allow price to manipulate early in the week, and then trade expansion towards liquidity later in the week. Our role as a trader is to align with market structure, liquidity, and time-based price behavior. This model is most effective from Tuesday to Thursday, particularly during London and New York session. Preparation is crucial before the week begins. Our first step will be review the economic calendar, focusing on high impact news events. These events often create manipulation and displacement, which we use to our advantage. Second, we analyze higher timeframe market structure, liquidity levels in key areas, the likely dealing range, and the overall market sentiment for the week. Step 3 is liquidity mapping. Once bias is defined, we identify potential liquidity draws such as old highs or lows, equal highs or lows, fair value gaps, and significant price delivery PD arrays like order blocks. Remember that targets are only considered in the direction of the weekly bias. All that being said, one of the most important concepts in CPM Model 2 is the Tuesday 12 AM opening price. This price acts as a weekly equilibrium reference. The rules are straightforward. With a bullish bias, seek buys at or below the Tuesday open, and with a bearish bias, seek sells at or above the Tuesday open. Early in the week, price manipulates against the bias to create liquidity for the coming expansion later in the week. Now let's move on to the trade planning. We will look for opportunities around Tuesday and sometimes Wednesday. If Tuesday doesn't work out, our goal is to manipulate into discount or premium PD arrays depending on the trade. Like in this bullish example, we expect the price to sell off below the Tuesday open, sweep the sell side liquidity, and tap into the discount PD arrays. Going into the lower time frame, our execution time frame will be on 5 minutes or 15 minutes time frame. The best entries happen around New York session, usually between 7 AM and 11 AM. If no valid setups forms on the Tuesday, we will repeat the process on the Wednesday. We will avoid chasing trades and forcing setups if it doesn't work along. In this example, on the weekly time frame, as you can see here, the price has taken the sell side liquidity of this weekly candle and also the CE of this weekly discount week. As the price has taken the sell side liquidity, we could expect an bullish scenario in this week. So going into the lower time frame, let's see how this works. Right now we are on the 15 minutes time frame. Here is the Tuesday opening price. This is the Tuesday and this is the Wednesday. As expected, price has sell off through the Tuesday opening price. After that, on the Tuesday, we didn't have any type of setup. So going into the Wednesday, as we can see here, price has taken the Tuesday lows on the morning session of the New York. After the Tuesday low has been taken in the morning session, on the 9:30 opening price, we could expect an expansion towards our bias. So as expected, this FVG acts as a bullish FVG. Price came back to this FVG and gave an expansion towards the equal highs of the Tuesday, means previous day highs, and our target has been accomplished. Once the price delivers the desired displacement, we hold for weekly expansion. This usually happens when weekly highs or lows form during the Thursday New York session. Our targets include old highs or lows, rejection block, and external liquidity pools. The maximum extension of the profit objective is up to Thursday high. This is where the patience pays off. Risk management is non-negotiable principle. Rules for the trade management are: entry should be placed using limit orders. Stop loss is set 20 to 30 handles below the discount array for long trades. Partial profits are taken strategically when 75% of the positions are closed. The stop loss is moved to break even. This ensures capital protection while allowing traders to realize profits. ICT's CPM Model 2 is not about trading daily. It's about precision, patience, and timing. By mastering weekly bias, Tuesday open, liquidity, and manipulation, you will cease overtrading and begin trading with intention and precision. If you want the entire PDF for this model, join my Telegram group. Also there I share my daily trade analysis and much more, so don't miss it out.